Robschild, no investment advice. Welcome to the show where we view financial markets through technical analysis, macro financial history, the principles of Benjamin Graham's value investing philosophy, and, of course, crystal ball gazing. Today is Tuesday, September 17th, 2024. Today's episode, we're going to start by bringing up the obvious humongous event. Tomorrow at 2 p.m. we have the Fed decision released. Right now we are priced at a 62% chance of it being a 50 basis point cut and around a 38% chance of there being only a 25 basis point cut. However you want to look at it, the Fed has basically explicitly said that they are cutting in this meeting, but we don't know how much. So why are they cutting? Well, they said they don't want to see further weakness in the labor market. So they see weakness in the labor market, and that's why we're cutting. To emphasize the gravity of tomorrow being the first rate cut of this cycle, if you look at the last 2 or 3 cycles, depending on how you count them, you can see in 2000, it was in December where we had our first cut. And then we went straight into the dot-com burst where rates had to go slammed all the way down to as low as 1% by 2003. And then we had another hiking cycle into, of course, the great financial crisis. It looks like August of 2007 where we had our first cut, going straight into the financial crisis where we had to slam rates basically all the way to zero. And then we started raising rates again up until about 2019. And before we even heard about COVID, by the way, we were cutting rates, and we were cutting, suggesting that we may have already been headed into a recession. And then COVID hit and we slammed rates to zero, and we had massive government spending, which sent inflation flying higher. And then we wanted to fight that by raising rates once again. And anybody see a pattern yet? We see the first rate cut coming tomorrow. Now remember, with our daily reminders, the 2-year, 10-year Treasury yield curve has been inverted for over 2 years. This hasn't happened since right before the Great Depression. We only recently had reversion of this, September 6th of 2024. We will soon likely get the reversion of the 3-month 10-year yield inversion very soon. I would imagine it would be happening within the next few months, pretty obviously. We also have the SOM rule triggered. Remember, the reason why the Fed is cutting is not because, inflation has cooled down. It's supposedly cooling down enough, and it might be cooling down enough, it might not be. But the point is that, the Fed forever has been saying, okay, we do not want to cut too early because inflation clearly became problematic, and we do not want that to be a continuing problem. So they don't see continuing inflation as a problem. They see a breakdown in the labor market. That's what they said leading into this meeting. This is why they said they're going to cut in this meeting. And, taking a look at the SOM rule being triggered recently, this suggests that the labor market is deteriorating at a pace that is unsustainable for the economy. Every time the SOM rule's ever been triggered, it has been the beginning of a recession. This was triggered in July of 2024, suggesting that we are actually potentially already in a recession. Add this to the fact that the S&P 500 currently has a PE ratio of 29 without major earnings contraction, all while bond yields are not extremely low. If they were extremely low, maybe this number might make sense, but this is a very high price for the S&P 500. This is very expensive, and so the crystal ball reading remains market crash incoming, and the Fed will not cut fast enough to save the economy. I think it's worth repeating that the hiking cycle was not as effective as the Federal Reserve and pretty much everyone expected. They thought, the Fed's hiking, they're going to slow down the economy, they're going to slow down inflation, and instead inflation took off. and the Fed had to chase it. Part of this is because of how much the United States has in debt right now. When you have fiscal dominance, hikes of the monetary policy, hikes of the federal funds rate are less effective for slowing down inflation. And on the other side of that, when we have cutting, I believe that that will be equally ineffective, to the point where I believe they will be very behind this in this cycle. On to some charts. SPX, the S&P 500, did break very briefly to all-time highs in the middle of the day, but this is not a closing all-time high, and so the bulls are not in control here. If they did become in control, if we did get a closing new all-time high, I am of the belief that it will not last very long. We might climb the wall of worry a little bit higher here, but with the Fed starting its cutting cycle, telling the market explicitly that they don't want further weakness in the labor market, it tells me that we will see enough weakness ahead to have the bears resume control. Many markets don't show hardly any fear besides maybe oil and the VIX futures term structure. Again, the October contract is elevated now, it looks like, above all the way through February, so the next 4 months. And so this market is suggesting that we are expecting volatility, major volatility, coming up through this month of September and next month of October. Tomorrow and the next several trading days, I expect to be very wild, to be really crazy, for things to really just go all over the place. And I don't really know where things will go necessarily. All I can do is take a look at where I think there's overvaluation and undervaluation. I still think Treasury bonds is a good place to be. I think gold has had a humongous bull market, and I can't trust something that's on an all-time high. I need it to go down before I buy it personally. Same with silver. The only equity markets I see worth owning right now, with a lot of undervaluation in my opinion, are Brazilian equities, Chinese equities, and rare earth strategic metals, miners, the REMX fund. These are my favorite 3 positions, along with long duration treasury bonds. I said on yesterday's show, KWeb, again, this is like internet companies of China, like Alibaba, JD. These companies are extremely undervalued by normal valuation standards. I said we were coiling up very tightly here, and I was expecting a breakout to the upside or the downside, and we had a breakout to the upside. And I did say that I was expecting it to break out to the upside, partly because of the first Fed funds cut, along with dropping yields across the whole curve. This weakens the US dollar against other currencies, which automatically sort of at least give more a boost to the valuations of emerging markets, in terms of dollars. The last few notable charts, this is XHB Home Builders Index. I was surprised yesterday to see a closing all-time high, and we have another closing all-time high today. This makes sense with TLT having a lot of strength right now, because this suggests mortgage rates can go lower right now, at least temporarily, until credit spreads spread. That can reduce the amount that mortgages can drop. Also, XHB can and will lose value if nobody is buying homes and the actual price of homes starts showing some significant weakness, which I fully expect happening in the very near future. Wood, right alongside it, I mentioned it broke out of this trend line. It showed a little bit more bullishness today. All in all, nothing really matters today. Tomorrow is huge, and the rest of the week, because it's really like, people need to see what the initial reaction is, and then digest the movement before things can start settling again. This should be a very, very wild rest of the week. Perhaps, going into next week as well. It'll be, it's very exciting times in markets right now. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.